Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert, Michael Episcope. Now, Michael is a principal at Origin Investments, a private real estate investment firm that operates more than 5,000 multifamily units in 14 cities across 8 states. Michael brings 25 years of investment and risk management experience to the company and believes that calculated risk-taking in inefficient markets is the key to building wealth. After a 16-year trading career, rising through the ranks of the Chicago Mercantile Exchange and twice named one of the top 100 traders in the world by Trader Monthly magazine, Michael cashed in his chips and retired from trading in the late 2005. His new focus was on managing the wealth he accumulated and enrolled in the Real Estate Master's Program at DePaul University. Now, in 2007, Michael and his business partner founded Origin Investments. In the 14 years since its inception, Origin has executed more than $2.3 billion in real estate transactions with an average equity multiple of 2.4x and has never produced a realized loss for any of their 1,400 investment partners. So, guys, I'm excited to introduce my guest for today's show, Michael Episcope. Michael, how you doing today?
Good, thank you. It's funny when you read. I'm never sure which one of my bios gets sent out. So that's obviously the long version. So I'm not sure I can add much more than that. I can go back, kind of when I was a kid, or
right. Well, how about we just dissect a little bit? Maybe we'll go that route. But so I guess first and foremost, you haven't had a full-fledged career, for the last 30, 40 years in real estate. You got started as a trader, and so maybe we can just go up to that point, 2005. Obviously, you avoided the catastrophic crash of 2008, and ultimately, you guys founded, was it in 2007? So you guys founded right before that. So I would love to maybe start at that point in time in history, transitioning from being a career trader to moving over into the real estate world. And the one part of your story I didn't really mention, which I think was on the even more extended bio, was your involvement as a kid growing up with your father. I think your father owned real estate investments in Chicago. And so you kind of saw firsthand what it meant to at least be a landlord and have real estate investments in your portfolio. So again, maybe to start, at that transitionary period from going from being a full-time trader to moving over to the real estate world, and maybe speak a little bit as well to getting started right before the crash.
Okay. It was kind of a natural transition for me because I had spent about 9 years trading, and I had built my wealth in that career. And at the time, in 2005, I was done. I'd been down at the exchanges for like 17, 18 years. And really, I accomplished more than I ever set out to. My risk profile also changed. And that was the big thing that as I think about it, well, there was actually 2 things. Not only my risk profile, but the exchanges changed as well. The computers started to come in, take our edge away. And, I wasn't a good trader because I knew where we're going today or tomorrow. And it was interesting, as I became more well-known as a trader, I used to get asked opinions all the time. Well, where are we going? Where are we going? And I still get asked, even in the real estate market. I'm like, look, I don't know any more than the next guy, right? Everybody's got an opinion on what's going to happen tomorrow. But it was really about taking advantage of mispricing and misinformation and in the market. And that's what I was good at. And in terms of my risk profile, well, when I started in the industry, I was single, didn't have a penny to my name. I had, what I would consider an income that I could recreate, right, if trading didn't work out. So it wasn't a huge risk for me. It was very simple. And I always thank my boss, who I still am in touch with today. I'm like, thank God you didn't pay me, more. I probably would have never left and gone and been a trader. Anyway, at the end of my trading career, I had 2 children. I was married. I had another one on the way. And I was just like, I got to hang it up, right? There's nothing good that can come out of being in the world of trading where you're leveraging your capital 300 to 1 on a daily basis. And you get, suddenly these 3, 4, 5 standard deviation moves, overnight or to your position. And, things happen, right? And when you're on the wrong side of those, it's not fun. So I decided to exit that business. I didn't really know where I was going. That was 2005, late 2005. And I think I was on the earlier end of actually leaving that, but I stayed home for about 6 months. What am I going to do, right? I had assets and I had net worth, and I was really in kind of the ultra high net worth category. And I said, I need to invest it. I really need to figure this out. I have to go educate myself. And I went back to DePaul University, got my master's in real estate, and knew I wanted to be in real estate because I had always loved it as an asset class. And there's a simplicity to it, but a beauty to it as well. The ability to get your arms around it, value it correctly. Operating businesses, I didn't have as much. I wasn't as attracted to true operating business. I liked real estate, the cash flow, the tax efficiency. And that's what I did. I went back, educated myself. My partner and I, very similar backgrounds, kind of kindred spirits. We were both, traders. He left that business in 2000. He was then also doing real estate investment. And then we got together because in the beginning, it was really about just investing our own capital into deals and finding good deals. And our whole philosophy was, look, we can do better, right? There's got to be, because investing with others at that time was 2 steps forward, 1 step back. The world, as you know, looked very different in 05, 06, 07. And when I was a passive investor, it was pre-Jobs Act, and you had to go find these deals, and everything was done behind closed doors, and things were okay, but I didn't exactly have a stellar track record as a passive investor. And I said, we can do this better, right? And he agreed. And so, we went off and we started Origin, and we built a little team, and we started finding deals, and we were doing everything ourselves. We were the acquisition team and the asset managers, and we were writing the reports. And then it was really about I think it was about 2009 that we started taking in our first investors, because we sort of said, what do we want to be when we grow up, right? Well, we knew what we wanted the firm to do, and that was be a firm that was centered around our own capital, that we could find deals, that we would enjoy the benefits of real estate, right? The true benefits. Then we had to hire a team, and then we had to really, kind of look at this as a different perspective, because when you have a team, you have to amortize that over a larger pool of capital.
Yes.
And so then we started inviting friends and family, started our fund business in 2011. Most of it was our money. And I always tell people in the beginning, it wasn't really about building a firm and saying, hey, we want, to build this massive assets under management, and this is what we're doing, and we're going to build this balance sheet value. We just wanted to find good deals. That's it. Invest in them. And in the beginning, it was sort of like my partner and I were paying annual fees of 5%, and everybody else was paying 1.5%, right? And we were supplementing it, but we knew we were building something better. And it was really, I guess, it was that building that institutional platform for the individual investor that motivated us. I don't really have a desire to work for a pension fund or work for an endowment or invest money, for them and stuff. But for people like, for me, for my partner, for our parents, for people who have worked really hard, amassed their net worth, well, they deserve like a place where they can invest in real estate and get great returns with fair fees and great service and all of the things that the institutions, that they get from investing 20, 30, $40 million. And that wasn't really the market pre-2007. It's come a long way since then, but that was what motivated us at that time to build, the firm in sort of that philosophy. And I know it's a long-winded story. I'll fast forward a little bit. So fund 1, 2, 3, that was our sort of buy, fix, sell period. We're buying value add, agnostic about property type. We're really going after the investment returns. We grew from us as 2 investors back in 2007 to serving more than 2,000 today. We operate more as an LP. We only do multifamily, and really we do build, buy, and lend in the multifamily space, but not a lot in the middle today, the buy side. So it's been a fantastic run for us. I think one of the things that we're really good at is executing, and that comes through in our track record. We've recently been named a top decile manager by Preqin, and that's because of where the returns have fallen in our previous funds. So it's been fantastic, and I think there's just going to be more growth ahead, but measured growth where we can continue to deliver the same quality as we have for the last 14 years now.
Yeah, no, that's great. I appreciate you sharing. And I'm going to back up a little bit and just hit a couple of points before we move forward. I want to talk about, you guys founding your business in 2007. Obviously, we all know 2008. Don't want to beat that dead horse any more than what it is. But I want to talk about being a disciplined investor at that point in time. I mean, you guys were just getting your footing, just setting the foundation. and one of the most volatile times that most of us listening to this can remember, right? At least as it pertains to just real estate and the market in general. And so, just what did those first couple years look like? I mean, I feel like everyone, even the most sophisticated real estate investors were kind of just, let's wait and see what the heck's happening here, right? The world's falling apart. And so talk to me about origin. How did you guys find your footing during that just uncertainty?
No, it's a great question. And I'll say, like, in the beginning, we didn't really have a defined investment plan. In '07, the cracks started to fall, they started to show as well. And all the deals that we were looking at, we were new to the market and we were looking at deals and talking to people. They didn't really stand up to any scrutiny. And we had a lot of people who were looking for rescue capital on deals, and you could see things starting to fall apart. And there was one day, it was kind of an aha moment where a guy walks into our office and he wanted us to bridge a loan for him because somebody had bought his mortgage. And it was on, I think it was a retail parcel or something like that. I can't remember. But, let's just say the note value was $6 million and the bank sold it for $3 million. And he wanted us to come up with a loan for him for $4 million. Well, we didn't do that deal, but the wheels started turning and we said, that's where we want to be, right? We want to be the group buying it for $3 million. And that whole mentality just shifted, right? How do we get edge in the market and protect ourselves? Well, in '08 and '09 and '10, the way that you acquired real estate was really through the process of dealing with the banks, the CMBS lenders, things like that, putting a lot of equity in. And it was crazy back then. But I think, you could underwrite to such ridiculous sort of cash on cash returns. Nobody knew what appreciation was going to do, but you're like, look, this building's half empty and we're able to buy this, with 14% cash returns and they've got stability here, and looking at this stuff. And you're just like, yeah, this is kind of a no brainer, right? Like this stuff. And, if you held that stuff for a long time, you did really well. So that was the first thing that really worked out for us. But that was a moment in time. And I would say that lasted, '08, we were a little bit early. We bought some things then, but we did fine. We held those for several years. That was the falling knife. '09, we bought a lot. 10, we bought a lot. And then 11, we really gravitated towards the value add space, because what you realize is that real estate is a leverage game, and you also want to buy quality. And there were some quality assets that were really starting to trade at that time, but trade at significant discounts to replacement costs. There was still stuff coming through the banks. And that's when our investment strategy really started to take hold. And that also corresponds with when we, at that time, 2011, we had a team of about 7 or 8 people. So a lot of, what David and I did is recognized our limitations, the fact that we weren't from the real estate market, right? He had done some development. I got a master's in real estate. We obviously, 08, 9, 10, it felt like we got our PhD. But in 11, we were hiring experts and people from institutional organizations, and our strategy was then really just defined more going in, and that was 2011 and beyond, that we were buy, fix, sell, value add, buying quality, using leverage, but a responsible amount of leverage. And we always say at our company, you only need to get rich once. So we're not one of these companies that goes in and we're leveraging up to 80, 85%. We're guaranteeing debt. We're cross-collateralizing assets. What you said in the beginning of my bio, we are really good risk managers, and our job is to make sure, number one, that we don't lose money. And number two is that we position ourselves in a way, right, and make really good choices and put ourselves in good assets and let the upside take care of itself.
Yeah. No, I love every bit of that. And a few minutes ago, you had mentioned that you guys were, asset agnostic in the beginning. However, you guys, you've tended to shift, to multifamily. That is your asset class of choice. What were some of the other asset classes, years back that you guys dabbled in, and ultimately, what made you land on multifamily as the place that you wanted to put all your bets on?
Yeah, we did everything: industrial, office, multifamily, retail, student housing, a little bit, because when you go back to that period in '09, when you look at the leverage in the market, well, at that time, capital had all the leverage. So as long as we showed up, we were good at pricing assets, underwriting. We would bring in experts into this. We were basically, we didn't care. If something was cheap enough, we'd buy it, right? And that worked out very well for us during that period. As the market normalized, capital became more and more of a commodity and had less leverage, and then became Well, in order, when your margins are really big, you can make mistakes and you can survive those, right? But in today's world, when you look at the margins, which have compressed, you have to know and understand how to underwrite to the pennies, the nickels, the dimes, the insurance, the property taxes, the operating expenses, the building, et cetera, underwriting the revenues accurately. And so the world has sort of shifted, and we recognize that early on. And the message to the market is so much clearer. When you tell the market, well, what do you do? And you say, well, we do everything. Just show us a deal, right? Well, really what they hear is you do nothing. And so when you go into the multifamily space, and that's all we are today, and you're dealing with the multifamily brokers out there, and you're dealing with the sellers, and you know every asset in the market, and your team is focused on one single asset class, including the investment management team, the asset management team, the property management team, everybody, then you can really manage this stuff the way it should be managed and pick up those pennies and nickels and dimes. And that matters, when you're trying to generate investment performance. So for us, it has been an evolution, but it's absolutely where we should be. And the reason why you asked multifamily, well, it's something that can't be disrupted by the internet. It's a necessity item, and it's something that we've always done really well at. And the kind of the fundamentals going forward are very strong in this. So that is what we've chosen. We've done other work. Even in Fund 3, we had some office in there. We're going to do fine in that, but maybe we should have done some industrial along the way. But I love specialization is the key, I think, in any business to getting ahead and beating your competitors.
Yeah, no, I agree with you there. And so you'd mentioned the first couple of funds were mostly value add funds. But fast forward to today, that Origin Investments, for the most part, acts as an LP. Can you explain that strategy a little bit more in depth?
Yeah, so we'll bring 90% of the capital. We buy direct, meaning we will buy the asset, we'll own 100% of it, but we also joint venture with a lot of people out there. We do a ton of development right now. And, it's about being flexible with our capital. If somebody needs preferred equity, we will originate preferred equity on the deal. If there's a development that's shovel ready in one of our approved markets, then, we can be the 90%, 95% capital on that. If there's a development that, we find we can do directly. So it's always been about being nimble, being tactical, being agile in this market, and providing solutions not only on the ground, because that's what our acquisition teams need. They need capital no matter where we are, whether we position in the GP part of the capital structure, the LP, preferred equity. They're going out there and talking to developers who are like, what do you have, right? This is what I need. And it's nice to have those conversations. On the other side, you have the investor. And what do they want? Well, some of them want growth, some of them want income, and some of them want a combination of both. So depending on our investment strategy, right? Different funds take different deals to produce the benefits to the investor.
Got it. No, that makes sense. And before we started recording, we had talked a little bit about where the pricing is actually at today on the multifamily assets, and we had briefly hit on the cost of acquiring an already existing vintage product versus developing from the ground up. And at this point in time, it seems that Origin is much more moving towards new development than that of a vintage product. Can you maybe add some additional context to that?
Yeah. There's been a couple, I think, distinct changes in the last couple of years. Number one, we're more buy, fix, hold today than buy, fix, sell for reasons you and I talked about, and that's really if you want to build real long-term wealth, you don't buy, fix, and then sell a great asset. You buy it, fix it, and then hold it for the duration. So did I just disappear? Okay, I'm back. So I think my camera went out for a second. I don't know. But you hold it for the duration. And by the way, that formula works across real estate. It works across collectibles. It works across stocks. It works across everything. So the world, though, that we're in, and real estate investors are used to seeing this, is they all want to chase IRR. Right. And then, sell a deal and round turn it. And that sounds great. But I know you deal with high net worth investors and wealth managers as well. And it's nice to have a round turn. But at the same time, we get them the complaints. Awesome. Well, why don't we hold this? Why don't we just cash flow it? What am I supposed to do with their money? Right. And the real answer, like when we were doing buy, fix, sell, that was the strategy. But going forward, it's all about buy, fix, hold. long-term to take advantage of the tax advantages of real estate, unlimited appreciation, the ability to refinance tax-free, et cetera. And your other question was related to, remind me for a second.
No, just you're buying existing product versus
Oh, right. I'm
ground
sorry,
up
the
build,
market.
which my guess is that it speaks much more. It's much more akin to that of a long-term hold, right? You're building something from the ground up. If you got new mechanicals, you've got less maintenance. You know what you have. You know what product you have versus buying that of a 40-year-old building that's got
and
mechanicals.
So what we were talking about was existing product, and our strategy is build, buy, lend, but we're not doing anything in the middle right now. There's always exceptions to the rule. We're actually looking at our first acquisition in, I would say, a year and a half. It's a really special situation, but when you have existing deals that are 10 to 15 years old, who are, that are in need of a value add already, and they're trading for 5% to 20% over replacement cost, we would much rather build brand new than buy a value add asset, put $20,000 per unit into it, and then think that we're going to be selling it for 35% above today's replacement cost in 5 years when the asset is now 15 to 20 years old. That, to me, there's something going on. There's just too much capital in that space. So I think it's a great time to sell. And so in our legacy funds 2 and 3 right now, we're using the strength in the market, and we are just letting go of everything we can. And we've sold more in this last year than we had in the, I would say, 6 years combined in today's market. Now, we're long-term investors, and we believe that basis matters. And that's why in these markets, when you're going to Nashville and you're going to Phoenix and you're going to Austin, for us, the best way to enter these markets is through ground-up development, because we're in at such a better basis. Yeah. So if the market does, go down, I'd rather be in a brand new product at $220,000 a unit than one that's 15 years old at $240,000 a unit. And that just makes sense to us. And if the market keeps going, guess what? That brand new product is going to trade a lot higher than that 20-year-old product. Yep. So, you see these imbalances and you scratch your head and you're not quite sure how we're going to get out of these, but you got to know when to sort of stay away, right? And when to come in with hands wide open and say, I'll buy everything, right? Yeah. And in 2010, it was, you should have bought everything. Didn't matter. There was no bad price. Today, you got to be really careful and be nimble around the edges. So we're choosing to lend and we're choosing to build.
Yeah, no, I love it. Speaking to markets, you mentioned Nashville. That was one of them. I think you hit another one I didn't catch. But which markets or what markets are you bullish on? And on the flip side of that, where are you guys avoiding? Are there certain regions that you're avoiding?
I would say Sunbelt markets, tax-friendly states. I mean, it's not the markets we're in are the markets a lot of groups are in. It just depends on how we're entering them versus how they're entering them. We're in Tampa. Love that market right now. We're in Charlotte. We're in Atlanta. We're in Nashville. We're in Austin. We're in Dallas, Phoenix, Santa. Just all. Yeah. What's the other one? I'm trying to think. Salt Lake City. Looking at Las Vegas. So the markets that are really benefiting from you kind of in a post-COVID world, and we believe that is going to continue, but it's always looking at the supply versus household formation in these markets, and it's going to take a while to see what normalcy looks like. Because interestingly enough, we're not investing in Chicago. We have properties here, but you can't ignore the fiscal situation, the migration to the south, into more tax-friendly states. But we've seen a tremendous amount of demand pick up here, and it was sort of after, it was more this year. But a lot of those one-way moving trucks that we thought were gone and these people were gone for good have come back. And it's, we had a property in the West Loop of Chicago that went from, I think it was 78% leased at one point. We bought this, couldn't have been worse timing. It was like March 10th of 2020 that we closed. And it was like, boom, right? Like we're writing down an asset in 30 days. It was just like the worst timing ever. And that was sort of like that week where you're like, wait a minute, what's going on? And people were like, oh, this is going to be gone in 2 weeks, 3 weeks. We've never seen anything like this. But that asset, we bought it. It was 98% occupied. Great location, really good asset. We put on, luckily we put 40% of equity in it. So we were very conservatively leveraged on that deal. But fast forward today, that deal is back up to 98% occupied from a low of 78%.
Wow.
So the market up here has actually turned around, and it's weird to me to think that there could be strength everywhere in this country. But the reason is because of the fundamentals, that there just hasn't been enough housing built in the last kind of 10 to 15 years because of the '08 crisis. So you have many of these millennials who are just trapped, and they're forced to rent because they can't buy a home because it's undersupplied right now.
Yeah.
So we love the fundamentals in multifamily, but it's hard to justify investing in Chicago in ground up development today when we have the fiscal situation we have, where you can go to tax-friendly states like, or tax-friendly cities like Nashville or Austin or Tampa or any of these other cities where you just have demographic trends that are favorable for the next 5 to 10 years.
Yeah. Speaking back to the multifamily property there in Chicago, how long did it actually take you to get back to that 98%? When did you see that shift start reverting back to folks moving, from the south back up to the north again, that you again thought they were one-way moving trucks?
I would say where it really shifted was in the beginning of the summer. That I think a lot of companies began to announce, hey, we're going back to work. And people were using that year home away from school. Then they started coming back up to Chicago. But the switch just went off overnight, and it was, you couldn't have given away. It was crazy. But even if we would have put up a sign that says 12 months free rent, we could not have rented anything. Wow. So at that time, when we were kind of in that COVID moment, it was about retaining our existing tenants. We didn't want anybody else more to leave, because we were getting 3 tours a month. Generally you'll get 30, 40 tours a month, for these buildings. And there was just nobody looking for apartments. It started to shift, I would say August, September, October of last year. We started to pick up in sort of those, kind of low 80s. So we're like, okay, the bleeding has stopped here. But then it was the beginning of the summer, May, June, the switch just flipped.
Yeah. Interesting. Talk to me about any unique retention strategies that Origin enacted, in order to save what you had there. I mean, was there anything that you guys did that was just absolutely out of the box that just helped you in the long run?
Well, there's 2 things we did. Number one, from the investor relations side, we did a couple things on that side. Because I think about it in 2 ways, right? You want to communicate when things go bad, and that's when you have to run information out. And we have that saying that bad information gets, it gets sprinted out, and good information, you can trickle that out over time, making sure that it's there. So what we did is, the world stopped, but we made sure that everybody in our investor relations department called, emailed everybody in our database. And we have 2,000 investors, right? Hey, just want to let you know. And then my partner and I got on webinars. And the question was, well, what are we going to say? And we're going to say, we don't know what's going on. That's what we're going to tell people, because that's the truth. We don't know. Nobody has been here before. And you can't take the playbook out of the early 1900s to figure out how this is going to impact real estate. And I honestly think that people just liked the fact that, look, we're doing everything in our power. Our money is next to yours. And it's really, like, when you think about it, it's the decisions you make before a crisis that matter, because a lot of times your hands are tied in a crisis. So what I talked about earlier, the risk management, well, we put in a tremendous amount of equity in all of our properties, 30% at the least, generally, all the way up to 40%, but targeting that 35%. We don't use recourse loans, right? So that's a huge thing. We don't cross collateralize assets in our funds. And we buy really good assets, high quality assets, the multifamily, which, tends to be a little bit more protected from the demand side. So those are all the things that we did, but the communication part was really important. And then when it came time for the retention part, our investment management team did amazing. And they came up with this plan called Operation Surprise and Delight, because it was all hands on board about, listen, these are now our best friends, in the world right now, our tenants who are paying, us rent right now. And that's what it was about. It was about reaching out on the ground, making sure that we're happy, bending over backwards. If they had an order, a ticket to repair something, we were there in 24 hours. So I give them a lot of credit. And our portfolio outperformed. We benchmark everything. And from an occupancy, from a collection standpoint, everything that you can measure, we outperformed our competition significantly during that period. So it was just great to see everybody who kind of looked at this as an opportunity, like, hey, here's my moment, I'm going to shine. And they did, and we did as a firm. So I'm really proud of the way that we handled that during that period.
I love it. Is your property management vertically integrated?
We're not, no. And that's kind of on purpose for us, because we really want to focus on the investment management side. And because we're in so many markets and we're in different, we're in Garden and we're in Podium and we're in Wrap and things like that. And I couldn't look an investor really in the face and say, listen, we have the best property management in all of these cities and all of our properties, et cetera, et cetera. Yeah. And the conversation a lot of times, it kind of lends itself to, well, hey, when we sell this property, what do we do with these 7 people? And by the way, we're getting rid of this $70,000 a year in income. Do we really want to sell? Now, I'm not going to say there's never, but it could be something that we do in the future because we're holding much longer, right? Mm-hmm. But if we thought that we could do a better job, we would. There's some really good property managers, and I think we like the way this is set up right now. And a lot of people do it. And I know you are vertically integrated because they have that control. And I'll say that we are an asset manager that is as vertically integrated as you can possibly be, mm-hmm. without having the headache of having thousands of employees. Because our investment management team, they have a playbook. And when we acquire a property, we're generally working with the property manager at that time, and they're adhering to our playbook because we know, what really makes the tenant tick. And we're monitoring all of social media, everything. And our team, every day they get in, we're fully integrated in terms of that side. So if there's a bad review on any one of our 40 to 50 properties, we know it in the morning. And we are on the phone with that property manager, and they are doing something for that tenant.
I love that. No, I love every bit of that. So you guys don't just have an asset manager. You guys actually have a team behind the scenes that is on top of every aspect of property management. You're just not physically involved, boots on the ground, property management. So that's
yeah. And there's a difference, right? Because I've seen asset management groups that do nothing more than report. They take the property management report, they make it look pretty, and they give it, to the event. It's not what we do. We are hands-on, involved in the process, because you really have to be from top to bottom to, again, it goes back to understanding the pennies, the nickels, the dimes, and what makes these properties operate and staying up on the latest trends. So very, kind of proud of what the investment management team has been able to put together, especially because they don't, we're not vertically integrated down to the property, but we're as much as we can be.
Mm-hmm. No, I love every bit of that. And shifting gears here real quick, Michael, we're running out of time. Just want to make sure I get a couple additional questions in here. But one question I always love to ask is, we always talk about all the deals that went the full cycle. We did, 2+X with, and I know you guys have never had, Origin's never had a realized loss across your entire portfolio, since the founding in 2007. However, we've all had challenging deals. We've all been involved in that deal that, kept us up late at night, gave us extra gray hairs, made us lose our hair, whatever the case may be. It added a complexity to our life that we didn't enjoy and added stress. And so when I hit on those different pain points, is there a deal that comes to mind, a deal that just you wish you would have maybe never bought in for X, Y, and Z reason? If so, what is the deal? What were the challenges associated with it? And ultimately, going back again, what would you have done differently the second time around if you chose to buy it at all? Is there one that comes to mind when I say all that?
Yeah. And let me clarify. We've never lost money on a deal in any of our funds, right? And so that's all we operate as a fund. But certainly, I told you in 2008 we were catching a falling knife, and there was, a deal that we lost money on there. So I don't want to give people I've got battle scars. And what I was saying earlier when I introduced myself, 2 steps forward and 1 step back. Well, sometimes it was 2 steps forward, a punch in the face, and fall on your back, and 3 steps back. And so. Yeah. There's a couple that I can talk about, and you look at it at the time, and I'll just say this before I get into details. But at the time, it was awful, and it was exhausting, and it sapped every bit of my mental energy. But it's also what led me to Origin. And I always tell my kids this, guys, no matter how dark and dreary it seems, right? You're either winning or you're learning, right? And there's no such thing as failing, right? You're learning along the way. And early on, I had a deal that like a lot of people, a friend of mine told me about, hey, you got to look at this. This is an unbelievable deal. And it was a great deal. It was down in Texas, and it ended up, it was a multifamily deal down there. I'm not going to name names, but I ended up investing in it, and we had the majority of money. I didn't really know what I was doing. This is when I was a high net worth investor. I should have made different rules. There were things in the PPM that, came out later, but I ended up in litigation on the deal because the deal was bought unencumbered. Totally unencumbered, right? We went into '08. We knew it was good real estate. So what? It's unencumbered. It's multifamily. It was kind of a future development site. And suddenly, like, things started happening in this sponsor's world, right? Things started falling down around them, and no reporting happened, and things started getting a little squirrely, and the communication stopped, and so all of a sudden, I don't remember how I got wind of this, but I had a lot of almost anxiety over what was happening in this deal because. Don't remember exactly, but I was doing an internet search at that time, and on a hard money lender site, our property was on there. Oh, and I was like, what just happened here, right? Well, what happened is this sponsor decided that he had a right to leverage up our property and then use the money to rescue his other properties based on a clause in the PPM that allowed him to borrow money from the partnership or borrow money on behalf of the partnership. And so next thing you know, I'm on a plane, I'm hiring a lawyer, I'm going down to Texas, I'm on the stand, I'm doing, and I got to tell you, it was $80,000 in legal fees. I ultimately recouped, kind of 80% of my investment, but it was awful, right? And so real estate, yes, it's a physical asset, but it's about people. And it's really, you have to know who you are investing with, because it doesn't matter what's in the PPM, right? If it's somebody who's truly honest, you don't even need a PPM. You'll never look at it, right? Yes, you need a PPM, don't get me wrong, but you'll never look at it. You'll file that in the drawer, and you'll just talk about how to split the profits. And you'll understand that when things go wrong, there's things beyond people's control. There's macro events that nobody has control over, right? And so, but the flip side is true too. If you get, in with a crook, no matter how good your PPM is, so they will find a way to steal from you and do the wrong thing, right? And you always have to ask yourself, right? If things go wrong, do I want to be with this person? So I've got my share of battle scars. That one kept me up for a long time. I look at it now. And, it was one of those learning experiences. I didn't go broke. It was my second master's, as I like to call it. It was actually my first master's because it was before I got my master's. But, I look at it and I'm like, look, if this is what's out there, like, I can do better. Like, I'll be a better steward of my own money. And so that really drove, that was one of the primary reasons. And, I can spend another 10 minutes if you want going over some other ones.
I was just going to ask you about that one. I mean, what would you have done differently? I mean, was it just deeper dive due diligence on the sponsor? Would you have met him in person, shook his hand, looked him in the eyes, and felt maybe a little better about him as an individual, or a little worse about him as an individual? I mean, I guess what additional things could you have done, or would you have done given the chance?
Yeah. What would I do? Okay, like, assuming not do the deal, that would have been the first thing, because he was more, right. He was somebody who didn't have a balance sheet. He had a lot of experience. He had a nose for buying deals. But let's say I did the deal. What would I do differently, right, in this deal to protect myself? And again, a good friend of mine had known this guy for 15 years. I went to high school and college together, and he spoke very highly of him. So I went in, that was my due diligence. Yeah, great, you know him, it's good enough for me. Sure. You can trust him, but things went sideways. Well, the first of all is the golden rule, right? When you put in the money, you make the rules. And so you have to make sure that, when you're putting in a significant amount of money, and for me at that time, I think I invested like about $700,000 into the deal. So I really should have, scrutinized the LLC and made sure that I had approval rights for any major decisions when it came to financing, selling, et cetera. Because this guy put in, the typical 5%, 10% into this deal, which really wasn't a lot, but he maintained all the control into the deal. So that's probably one of the biggest things I would have done, because it was an individual deal, is just making sure I had control and approval rights over major decision making.
Got it. No, that's great. I mean, it's good insights. I mean, I think if you've been in real estate for any period of time, call it 5+ years, and you've been actively doing deals, inevitably you're going to have some battle scars. They might not be as severe as the one that you just described there, but ultimately you're going to have scars. But as you'd mentioned, they're lessons. You learn from them and you move on. I've got a close friend of mine that doesn't call them failures. He calls them seminars, right? Everyone's got their own spin on it. But yeah, absolutely.
Well,
You learn from it, you move on.
and I'll add this too. A lot of people don't like to talk about this because you feel stupid. You're like, God, you look back and you're like, there's so many things I would have done differently. And you feel dumb. And yes, I made some really bad mistakes, in that entire thing. And I could write a paper on this, but I'm happy to share it because there's so many people out there who are investing and they're loose with their money and they're going to make mistakes like this. And if I can share these stories and keep people from doing that, or investing somewhere else, it's worth it for me to tell those stories.
Well, here's another important piece there. I think that needs to be discussed is that I'm a huge proponent of testing your theory or testing your investment strategy with your own capital first, right? Before you start bringing in capital from outside sources. And so I guess you could look at it in that manner. Like you were learning the business, you were learning exactly what Origin was going to be or become with your own capital. You were putting your own capital at risk, learning those lessons with your own capital before you were bringing in, hundreds of thousands or tens of millions of dollars from outside investors. And I think it's just, you see a lot of new sponsors out there that they don't have the balance sheet, they don't have the net worth, they don't necessarily even have really the track record, and they've got an idea, they've got a strategy, but that strategy hasn't necessarily been tested yet, and it sure as heck hasn't been tested maybe with their own capital, right? They haven't necessarily put their own capital at risk before they go out to the world preaching about this amazing investment opportunity, whatever it might be, right? And so I respect that. I absolutely respect that. You put your own dollars on the line first before you put anyone else's. You learn it on your own dime before you learn on someone else's. So anyway,
well, thanks. And I would say like that, just taking that lesson, we've never not had control on a deal. And we've had sponsors said, no, I want control, I want this. And there's always a negotiation or an out or put right or call, but we always have decision-making rights on major decisions. And what the golden rule is you bring the money, you make the rules.
Yeah. Michael, for those that want to learn more about you and Origin Investment, where is the best place to find you? And then in addition to that, are there any current offerings that are open to invest in?
Yeah, origininvestments.com. That's our website. You can go there. We make it really easy for people to connect with us. You can connect with somebody in IR right there on the website. We've got a little chat feature. And if you want to just download any of our decks, you can also do that by filling out a simple form. And then we really leave it up to people if they want to have a conversation with us. So if you're kind of ready to take those next steps after you review the deck, you can call and you can contact anybody in investor relations, and you'll get an email with contact information once the deck is downloaded on that side. So, again, everything is kind of digital. We make it super easy.
Okay.
And then, I know you asked about offerings. Yeah, we actually have 4 open funds right now. One of them is our credit fund, and that's for qualified purchasers only. It's real estate loans, but it qualifies more as a security than it does real estate. And then in our real estate offerings, we have our flagship fund, which is called the Income Plus Fund. That is a multi-strat fund. We build, buy, and lend in that fund. 9 to 11% annualized return, open-ended, 6% current pay yield. So great fund. I'm invested in that personally. My partner's invested in that as well. And then we also have our QOZ fund, our Qualified Opportunity Zone fund. We just launched our second one last week. And I will say this, that if you don't know anything about QOZ, you need to learn about it because it is just a great program out there for tax efficiency and generating wealth. And then our next fund that we're launching is going to happen in January, and that's Growth Fund 4. That's going to be all ground up development, but that's going to be more a build to core fund. So investors can get out after 5 years, or they can stay in for as long as they want.
Okay, fantastic. And yeah, maybe we have to do a separate show about the Opportunity Zone strategy. I think that's a whole another topic. It takes a little bit more time than just a few minutes to cover that one. So would love to maybe chat with you at another time and maybe even bring you back on for another show to cover that topic. So
love to. Yeah, that's definitely an hour conversation.
It is. Absolutely. It's its own show for sure. Well, Michael, pleasure having you here. Appreciate you joining us and sharing, your insight, your knowledge, also, being little bit vulnerable here and sharing that story about some of the past investments that we've done as well. And aside from that, my friend, I wish you guys all the best. It's been a lot of fun having you here.